Hello everyone, welcome to EPK Capital's daily brief video. In this series we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Global financial markets on October 2, 2025, navigated a treacherous landscape defined by a deepening US government shutdown and the sudden announcement of a broad new trade offensive by President Donald Trump. Despite these profoundly negative domestic catalysts emanating from the world's largest economy, global equity markets displayed a surprising, and perhaps concerning, resilience. This report provides a comprehensive analysis of the day's key events, dissecting the market's counterintuitive reaction and exploring the underlying macroeconomic, political, and technological currents. The central narrative is one of a market grappling with a dual shock. On one hand, the US federal government shutdown entered its second day, with the executive branch actively weaponizing the disruption to exert political pressure. On the other, President Trump unveiled a sweeping set of new tariffs targeting pharmaceuticals, heavy industry, and consumer goods, sparking confusion and threatening to escalate global trade tensions. Against this backdrop, geopolitical risks flared as the US intensified its posturing toward Venezuela, while digital assets like Bitcoin surged in what appeared to be a direct flight from fiat system instability. The market's muted response to these accumulating risks suggests a complex dynamic, potentially reflecting a dangerous complacency born from a year of heightened volatility or a delayed processing of risks whose full, disruptive impact has yet to materialize. Global Equity Market Review, October 2, 2025 US. Indices, a resilient but muted response. In a striking display of resilience, US stock markets ended the day in positive territory, shrugging off the potent combination of domestic political chaos and new protectionist trade measures. The broad S&P 500, US 500, rose by 0.34% to close at 6,726.18, marking a new all-time high. The Dow Jones Industrial Average, US 30, posted a more modest gain of 0.09%, closing at 46,454.51. The technology-centric Nasdaq 100, US 100, was the day's relative outperformer among the major US indices, climbing 0.49% to finish at 24,885.13. Underscoring the lack of panic, the CBOE Volatility Index, VIX, often called Wall Street's fear gauge, remained subdued, closing at 16.03. This price action is deeply counterintuitive, occurring on the second day of a federal government shutdown and in the immediate aftermath of a presidential announcement of sweeping new tariffs. The market's calm demeanor suggests that investors may have already priced in a significant degree of political disruption and protectionist policy from the Trump administration. The global stock market crash of April 2025, which was triggered by the initial rollout of new tariff policies, was a violent adjustment to this new reality. That event may have conditioned investors to expect a high level of volatility and policy uncertainty as the new normal. Consequently, the events of October 2, while disruptive, are likely being viewed as a continuation of this established trend rather than a fresh, unexpected shock. The minimal gains could therefore represent a relief rally that the tariff announcement was not even more severe or that a swift resolution to the government shutdown is anticipated. The market appears to be assessing the marginal impact of these specific actions against a backdrop of already lowered expectations for political and policy stability in Washington. European equities, shrugging off inflation data. European stock markets posted strong gains, seemingly more influenced by a sense of relative stability compared to the US than by domestic economic data. Germany's benchmark DAX, the 40, index advanced 0.72% to close at 24,287.90. The pan-continental Euro Stoxx 50 climbed 1.11% to 5,643.00, while the UK's FTSE 100 rose 1.03% to finish the session at 9,446.43. These gains materialized despite the release of a Eurozone inflation report showing an acceleration in the headline annual rate to 2.2% for September, a figure slightly above the European Central Bank's (ECB) 2% target. European markets appear to be interpreting this data through the lens of monetary policy certainty. Core inflation, which strips out volatile components, held steady at 2.3% for the fifth consecutive month. With the ECB having already signaled the end of its rate-cutting cycle for 2025, the inflation print confirms this stance without suggesting an imminent need for a hawkish pivot. For investors, this removes a key variable. The bad news of slightly higher inflation is effectively good news, because it solidifies a stable and predictable monetary policy environment for the remainder of the year. This policy clarity stands in stark contrast to the administrative chaos and unpredictable trade policy announcements emanating from the United States, making European equities a relatively attractive destination for capital in the current environment. Asian markets, tech-fueled rallies and holiday closures. Trading across Asia was mixed, with several major markets closed for holidays, but was highlighted by a spectacular, technology-driven rally in South Korea. The benchmark Kospi index soared 2.4% to a record high of 3,538. This surge was powered by a landmark announcement that chipmakers SK Hynix and Samsung Electronics would partner with OpenAI to supply advanced memory chips for its ambitious Stargate AI data centers. The news sent SK Hynix shares soaring by over 10% and Samsung Electronics up by over 4%. Elsewhere, Hong Kong's Hang Seng Index, HK50, jumped 1.80% to 27,339, and Japan's Nikkei 225 index climbed 0.6% to close above 44,800. Trading was thin in the region as mainland Chinese markets were closed for the Golden Week holiday and Indian markets were shut in observance of Gandhi Jayanti. The extraordinary rally in Korean semiconductor stocks points to a powerful secular trend that is proving capable of overriding broader macroeconomic and geopolitical fears. The global economy is in the midst of an AI infrastructure build-out, a non-negotiable, multi-trillion-dollar global priority for corporations and governments alike. This makes key suppliers in the AI value chain, such as SK Hynix, a leading provider of high-bandwidth memory, HBM, to NVIDIA, appear insulated from cyclical downturns and geopolitical noise. The OpenAI deal serves as a powerful validation of South Korea's critical role at the heart of this technological supercycle. For investors, allocating capital to these companies is becoming a way to hedge against the political and economic risks plaguing other sectors, a bet on a dominant technological wave that transcends the drama of near-term policy decisions. The macroeconomic backdrop, data in the shadow of political turmoil, the US government shutdown deepens. The US federal government shutdown entered its second day on October 2, 2025, with no clear end in sight. 11 The shutdown, which began at 12:01 a.m. EDT on October 1, was triggered by the failure of Congress to pass the necessary appropriations legislation to fund government operations for the new fiscal year. The immediate impact is severe, with an estimated 800,000 to 900,000 federal employees furloughed and an additional 700,000 deemed essential, forced to work without pay. This shutdown is proving to be distinct from previous instances of legislative gridlock. It is being actively wielded as an offensive political weapon by the executive branch. President Trump has explicitly threatened to use the shutdown as leverage to enact mass layoffs of federal workers and to cut social benefit programs. In a move widely seen as an attempt to pressure Democrats, the White House has already paused or cancelled billions of dollars in funding for infrastructure and climate-related projects, specifically in states that voted for the opposition in the 2024 election. This transforms the shutdown from a passive consequence of inaction into an active tool for implementing policy and consolidating power, creating a far more unstable and unpredictable environment. A critical side effect is the suspension of key economic data releases from the Bureau of Labor Statistics and the Census Bureau, effectively blinding investors and the Federal Reserve to the true state of the economy at a particularly precarious moment. Eurozone inflation accelerates. On October 1, Eurostat released its flash estimate for September inflation, which showed the headline Harmonized Index of Consumer Prices, HICP, rising to 2.2% year-over-year. This figure was up from the 2.0% recorded in August and came in just below the market consensus of 2.3%. The core inflation rate, which excludes volatile items like food, energy, alcohol, and tobacco, held steady at 2.3% for the fifth consecutive month. The acceleration in the headline number was primarily driven by a much smaller decline in energy prices, which fell just 0.4% compared to a 2.0% drop in August, alongside a pickup in services inflation to 3.2%. Inflation in Germany, the bloc's largest economy, came in slightly hotter than expected at 2.4%. This data effectively cements a significant monetary policy divergence between the Eurozone and the United States. The inflation print reinforces the market view that the ECB, which has already cut rates 8 times since 2024, is finished with its easing cycle for 2025. Meanwhile, the US Federal Reserve is widely expected to cut interest rates at least twice more this year in response to a slowing labor market. This growing interest rate differential creates a fundamental headwind for the US dollar against the euro. This has broad ripple effects, making US assets less attractive to foreign capital, potentially boosting returns on international stocks for US-based investors, and providing a potential tailwind for commodity prices. The shutdown-induced dollar weakness is now being reinforced by a more fundamental, policy-driven weakness. The Reserve Bank of India's steady hand. On October 1, the Reserve Bank of India's RBI Monetary Policy Committee (MPC) provided a beacon of stability, unanimously voting to keep its key repo rate unchanged at 5.5% and maintaining its neutral policy stance. The decision marked the second consecutive meeting with no rate change, following a series of cuts that totaled 100 basis points earlier in the year. In its accompanying statement, the RBI upgraded its GDP growth forecast for the 2025-26 fiscal year to 6.8% from a previous estimate of 6.5%, while simultaneously lowering its forecast for CPI inflation to 2.6% from 3.1%. The RBI's decision represents a dovish pause, a masterclass in central bank communication amid global turmoil. By holding rates steady while expressing greater optimism on growth and inflation, the RBI is signaling immense confidence in the resilience of India's domestic economy. The pause is not a hawkish signal but rather a prudent decision to observe the full impact of past rate cuts and, crucially, to keep policy space available to counteract external shocks. The policy statement explicitly noted the need for greater clarity on tariff-related developments before charting its next course of action. This projects an image of India as an island of relative stability and predictable policy in a turbulent global sea, making it an increasingly attractive destination for investors seeking shelter from the volatility in developed markets. The tariff shockwave, President Trump's new trade offensive deconstructing the announcement. In a move that sent shockwaves through global supply chains, President Trump announced a new, aggressive round of tariffs via posts on his social media site, Truth Social, on October 2. The tariffs, which the announcement stated would be effective October 1, include a 100% tariff on branded and patented pharmaceutical products, a 50% tariff on all kitchen cabinets, bathroom vanities, and associated products, a 30% tariff on upholstered furniture, a 25% tariff on all heavy trucks. The administration's justification was broad and politically charged, citing the need to protect US manufacturers from the flooding of products and unfair outside competition, as well as for vague national security and other reasons. The timing of the announcement during a government shutdown, its delivery via social media, and its targeting of highly visible consumer and industrial goods suggest this is as much a political messaging exercise as a coherent economic strategy. By name-dropping iconic American truck brands like Peterbilt and Mack for protection, the administration appears to be aiming to rally its political base. The immediate confusion the announcement sparked among industry groups and even government officials regarding implementation details indicates that the primary goal may have been to project an image of decisive, America First action, with the economic consequences being a secondary consideration. The pharmaceutical gambit. The centerpiece of the new trade offensive is the 100% tariff on pharmaceuticals, which contains a crucial and powerful exemption. The tariff will not apply to any company that is building a manufacturing plant in the United States, a condition defined as having either broken ground or being under construction. The policy explicitly spares lower-cost generic drugs from the levy. This tariff structure is not a traditional trade barrier but rather a coercive tool of industrial policy, designed to force the wholesale reshoring of a critical global supply chain. The breaking ground clause is a particularly potent mechanism, creating an immediate, binary choice for global pharmaceutical giants: either commit billions of dollars in capital to US-based manufacturing without delay, or risk having your products priced out of the world's most lucrative market overnight. This is likely to trigger a frantic race among drug makers to announce US investments, potentially reshaping the industry's global footprint. However, this high-stakes gambit carries immense risks, including the severe disruption of supply chains for essential medicines, the prospect of immediate retaliatory tariffs from key allies like the European Union and Canada, and the potential for shortages and dramatic price spikes for American patients, the very opposite of the administration's stated goal of lowering drug costs. Geopolitical Risk Monitor, the US-Venezuela Flashpoint. Concurrent with the domestic turmoil, geopolitical tensions in the Western Hemisphere have reached a boiling point. An article published on October 2 posed the direct question, has the US-Venezuela conflict officially begun? This follows a series of escalating actions by the Trump administration. In September 2025, the administration controversially renamed the Department of Defense to the Department of War, signaling a more muscular foreign policy doctrine of peace through strength. The US has publicly accused Venezuelan President Nicolas Maduro of sponsoring drug trafficking, placed a $50 million bounty on his capture, and deployed advanced F-35 stealth fighter jets to nearby Puerto Rico. Reports indicate that top administration officials are actively urging President Trump to take action to overthrow the Maduro regime. The escalating conflict appears to be driven by more than just stated concerns over drugs or regional stability. It is a preemptive move to defend the US petrodollar system against strategic encroachment from China and Russia. Venezuela possesses the world's largest proven oil reserves, exceeding those of Saudi Arabia. The core strategic fear in Washington is that if a government hostile to the US and aligned with its chief rivals gains full control over these reserves, it could begin pricing its oil in currencies other than the US dollar, such as the Chinese yuan. Such a move would directly challenge the system that underpins the dollar's status as the world's primary reserve currency. The aggressive US posture is therefore a clear signal that it is prepared to use military force to prevent strategic rivals from gaining influence over critical energy assets in its hemisphere. This makes the US-Venezuela standoff a flashpoint with profound global implications for the future of the international monetary system. The digital asset market, a flight to perceived safety. Bitcoin and Ethereum price action. As instability rocked the traditional political and financial systems, the digital asset market saw a significant surge. Bitcoin rallied sharply, breaking past the key psychological level of $117,000 for the first time since mid-September and briefly touching a high of $117,356 before a slight pullback. Ethereum, the second largest cryptocurrency, also experienced a strong rally, decisively breaking through its critical resistance level of $4,300 to trade at $4,319. The moves pushed the total market capitalization of all cryptocurrencies to approximately $3.91 trillion. The narrative of fiat instability. Market analysts are directly attributing this rally to the chaos unfolding in Washington. The US government shutdown and the associated weakness in the US dollar are seen as primary catalysts, pushing investors towards assets like crypto. The shutdown is not just a background event, it is serving as the most effective, real-time advertisement for the core value proposition of decentralized assets like Bitcoin. Every headline about furloughed workers, suspended government services, and political gridlock reinforces the narrative of the fragility of fiat systems and their dependence on functional politics. Bitcoin, with its programmatic and apolitical issuance schedule and its decentralized network, stands in stark contrast. The rally is not merely speculative capital flowing to a risk asset, it appears to be a direct, reflexive response to a demonstrated failure in the traditional system. The shutdown is making the theoretical case for crypto tangible, accelerating its perception among a growing class of investors as a legitimate, safe haven asset. Technical outlook and analyst sentiment. Traders and analysts are now watching key technical levels to determine if the rally has staying power. For Bitcoin, sustaining a price above the $117,000 mark is seen as a critical test. If bulls can maintain control above this level, analysts see a potential move toward the $130,000 to $135,000 range before the current cycle peaks. However, a failure to hold this level could result in a pullback to a key support zone around $112,200.32 for Ethereum, successfully flipping the former resistance zone of $4,300 into a new level of support is considered a powerful bullish signal that could pave the way for further upside. Concluding analysis and forward outlook. While global equity markets ended October 2 with a deceptive semblance of calm, the underlying risks to the global financial system have intensified dramatically. The dual shocks of an operationalized US government shutdown and a new, aggressive tariff regime have introduced a profound level of uncertainty that has yet to be fully absorbed by investors. The market's placid surface may be masking dangerous undercurrents that could surface with little warning. The forward outlook is dominated by a series of critical questions. How long will the US government shutdown last, and what will be the extent of the political and economic damage inflicted by its weaponization? Will the US's closest allies and trading partners retaliate against the new tariffs, triggering a broader and more damaging global trade war? And will the flight to digital assets and other perceived havens continue as faith in the stability of traditional governance and finance erodes? The market is in a fragile state. The resilience shown by the major indices may be a testament to the power of secular trends like AI or simply a lagging indicator of troubles to come. Investors and policymakers alike must navigate the coming days with extreme caution, as the potential for a sudden and sharp repricing of risk remains exceptionally high. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel.